if I told you there is a stock so undervalued that its CEO is considering buying the entire company? Wall Street analysts can't explain why it trades at only 1.6 times earnings, while its competitors trade at like 3 times higher valuations, and it just posted a massive earnings beat despite market skepticism. This is, in my humble opinion, the biggest opportunity nobody's talking about while they chase the next AI stock or are worried about the sell-off. Now, Winston here, of course, has done all that research, haven't you, Winston? There he is. So, take it with a pinch of golden retriever salt. But I've spent the past 3 weeks analyzing shipping companies. Yeah, not the most glamorous sector. It's actually one sector I used to cover when I was working in banking. But that's precisely where the money is right now. Look, for those of you with TikTok brains and short on time, here is the essence. My trading experience tells me ZIM, Z-I-M, is that rare financial phoenix story. They've pulled off what I'd call the shipping miracle of the decade, transforming a staggering $2.7 billion loss into a $2.1 billion profit in just 12 months. What's actually mind-blowing, well, while the market sleeps, this company is sitting on $3 billion cash, more than their entire market cap, yes. And it's trading at valuation levels that make absolutely no sense unless you believe global trade is ending tomorrow for good. Even their own management team is essentially saying, if you won't value us properly, we might just buy the whole company ourselves. And look, I've spent years in trading and I've learned that shipping stocks were always the ugly ducklings that made the most money during market transitions. Just earlier in March, ZIM announced their Q4 results. They beat expectations of the market by 30%. Yet the stock, well, it actually dropped. Why? Because most investors are too focused on the general panic happening in the US and ignoring these cash-generating machines if you time them right. Now, I want to be completely transparent with you. I don't own the stock, but I plan to own the stock. And I will walk you through, we look at the chart together, and I'll tell you where I plan to buy, just to be 100% transparent. And if you felt that the last few weeks were a little queasy, didn't feel that good to see your stocks down 10, 20, 30, 40%, depending on what you're in, well, you know that that's actually avoidable. That pain is not necessary for you to repeat every single time the market dips. It does this kind of dip, by the way, every single year. So if you want to avoid that, well, you need to learn where you sell. Because yes, the hodlers will tell you you should never sell, but that is just nonsense because you are not doing this to please a stock. You're doing this to make money for you and your family so you can live a beautiful free life. Isn't that right? And what happens after the sell-off is finished? The greatest opportunities, the greatest money-making opportunities will spring up. Thousands of them at the same time, and you'll be like, I don't know which one to pick because I don't really have a framework. I don't really have rules. And I don't know if this is the bottom of the market, is this the rally, is this, right? That's what most of us go through. That used to be me. And then I was really lucky. I landed a job in banking and I had a lovely boss who taught me. Not just because he was lovely, but because, well, he wanted us to make more money as a team. And if the team makes more money, he got a bigger bonus. That's the motivation. That's why the bankers learn. So if you want to learn exactly what I learned there for free, I'll give you that knowledge. It takes 15 minutes to learn. All you got to do is watch my free masterclass. It's down below. It's at felixprehn.org/get free because I want you to get free. I managed to quit the corporate rat race. I no longer have working hours. I no longer have an alarm. I wake up. I occasionally stumble over here into my little studio and I like to record and share things because it's insanely gratifying to see so many of you doing so well because of it. So go to felixprehn.org/get free. Now, what surprised me most about ZIM wasn't just the numbers. It was how the company has positioned itself for what's coming next. So are you ready to see why this might be the most compelling contrarian opportunity of 2025? The answer to that is yes. Write opportunity in the chat. If that's too long a word for you to type, OPP will also do. So let me show you what my researchers uncovered here. First, what's actually happening in the shipping world right now? Well, let's take a step back and look at the bigger picture before we zoom in on Zim specifically, because to really understand the opportunity, you need to understand the market. The global shipping industry is growing at about 3% a year. Not exactly headline-grabbing stuff, right? But here is what most people miss. It's the underlying complexities that create these pockets of opportunity. The key trade routes between Asia and Europe and Asia and North America continue to dominate global commerce. I mean, just think about it. Almost everything in your home probably traveled on one of these routes at some point. Now, what keeps shipping executives up at night? Well, quite a lot, to be honest. The industry is facing the perfect storm of challenges that are creating winners and losers. Freight rates have been on this roller coaster ride since the pandemic. They shot up, then they came crashing down. Now they're stabilizing, but still face downward pressure. Have you noticed how shipping costs affect literally everything you buy? Well, it's one of the reasons inflation is abating. And that's exactly why this matters to everybody, not just investors. And then there's the fuel situation. Costs are up, which eats into margins, which don't even get me started on geopolitics. But here's where it gets really crucial for understanding Zim's position. I'm seeing two major transformation factors reshaping that whole industry. First, environmental regulations are forcing massive fleet upgrades. Companies that don't adapt will literally be banned from major ports. And second, digital transformation is creating this massive efficiency gap between the modern operators and the dinosaurs of the industry. And that's exactly where Zim has quietly been making its moves. While everyone else was distracted, they've been aggressively investing in LNG-powered vessels. That's liquefied petroleum gas, which, by the way, is not just cleaner, but it's also 22% more fuel efficient. So think about that, what that does in terms of costs compared to competitors. And the most telling indicator, well, their balance sheet. Zim is sitting on $3 billion in cash in an industry where capital flexibility determines who survives the bad times. So it's basically like having an insurance policy and a war chest combined. So I have to ask, when was the last time you considered how shipping companies actually make money? Does it make sense why some thrive while others barely survive? Well, let me know in the comments if you've ever invested into shipping stocks before, because can be a complex industry. But the company itself is even more fascinating than the industry dynamics. Let's look at what makes Zim different from the rest of the pack here. Unlike the massive carriers trying to be everywhere at once, Zim has taken this laser-focused approach on specific trade lanes, particularly Asia to the US East Coast and Latin American routes. So instead of opening a restaurant chain across basically the whole country, they decided to dominate specific neighborhoods with exceptional service. And this targeted strategy allows them to optimize operations in a way that larger competitors simply can't match. Their fleet modernization program is also very impressive. By the end of 2024, so last year, over 50% of their capacity came from new build vessels, but 40% of them are powered by LNG gas, which brings the millions in savings flowing directly to the bottom line or to shareholders. But what really caught my attention was their digital approach. They have this crazy real-time cargo tracking integrated supply chain system that would make Palantir customers drool. And to really understand the stock, we need to talk about numbers. Not everybody likes numbers, but when I looked at them, I was like, are you serious? Zim is currently trading at a PE ratio, so price over earnings, price over profit, right, of approximately 1.6x. Let's let that sink in for a moment. The industry average is around 10. Their direct competitors like Maersk and Hapag-Lloyd are trading at about 5. So what does this mean in plain English? The market is essentially saying we don't believe Zim's profits are sustainable. But here's what they're missing. Zim just posted a $2 billion profit for 2024. And even more telling is their price to sales ratio. It's 0.3. Industry average is around 1.5, so 5 times higher. Their revenue grew 63% year over year. But undervaluation alone isn't enough. We need catalysts, specific events or trends that could trigger a re-rating, and that's exactly what we're going to explore next. So Zim has several potential game changers on the horizon. The most intriguing catalyst, and frankly the one that got Winston's ears perked up, didn't it, Winston? Winston? There we go, ears perked up. There is a potential management-led buyout. Zim CEO Eli Glickman has been exploring this option, and it makes perfect sense when you look at the numbers. You see, Zim has no dominant shareholder who would stand in the way of this. But there's the truly mind-boggling part. The company's net assets are worth approximately $25 per share, which is about 56% higher than the current stock price, around $16? Yeah, $16.40 as we're recording this. And that's just a conservative estimate. Some analysts I've spoken with value it north of $50 when accounting for the contracted fleet agreements that's worth billions of dollars. But think about this for a moment. Would you sell your house for 40% less than its appraised value? Of course not, right? That's essentially what's happening with Zim right now. If management executes a buyout at even a modest premium to the current price, early investors could see a pretty significant return. And the second catalyst is their fleet modernization. I spent 3 days literally going through their fleet data, and I have to tell you, their investment in these LNG-powered vessels is huge. These ships are not just better for the environment, they are just much, much more efficient. I mentioned it earlier, they save about 20-25% fuel costs. And fuel is about 40% of operating expenses for shipping companies. So it's an enormous saving. It's a 10% improvement on margins. And what does that mean? It means that Zim can now be the cost leader. So it's not just about surviving the next downturn, it's about thriving while competitors struggle to break even, much as I'm struggling with these soft ears here. So the third catalyst is their niche market focus. While the Maersk and Hapag-Lloyds try to dominate everything, Zim has this brilliant approach of targeting very specific high-value routes only. Now, the shipping market is notoriously fickle. Freight rates go up and down, but we're seeing signs of stability. In 2024, the average freight rate increased 57% year over year, which is still well below the pandemic peaks, but it's a healthy kind of normalization. And global trade volumes are going to grow modestly, not a huge tailwind, but still a tailwind nevertheless. But if you forget about all of that for the moment, what actually makes a company great? Well, it's typically management. And what really stands out to me is management's execution through the really challenging times that shipping has just been through. Bouncing back from a $2.7 billion loss to a $2 billion profit doesn't happen by accident. So their strategic initiatives, their vision are basically fall into 3 areas here. First, the LNG-powered fleet that they're aggressively expanding because it just saves so much in costs and therefore gives them a competitive advantage. Second, doubling down on those high-growth trade routes. And third, and this is crucial, they're maintaining this fortress-like balance sheet, $3 billion in cash. In shipping, cash is king. It allows you to weather the downturns, take advantage of distressed asset sales, and fund growth. And they're also paying a massive, whopping dividend on top. So when I look at management's track record here, for me, it's kind of hard not to be impressed by it. They've consistently demonstrated that they can adapt to whatever is thrown at them. Now, we understand the fundamentals here, so how do we approach this as an investor? Well, I've pulled up the chart here in tradevision.io, which is the tool that we use to basically give you insanely good quality data and analysis and indicators and everything else. And what I was surprised by, and that's really why I think this is a fundamental contrarian opportunity, is we had earnings here, and the stock massively dipped as a result. We went from $20 to like $18, at one point even $17 and a bit down here. Now, notice the candle of Friday, and it's that one here. I'll redraw it for you so it's a little bit clearer. The candle looks like this. Right, that's the candle. That part here is painted in. So what does that mean? Well, it means that we dropped all the way down to here, which was scary, at $17.30. And then we rallied up almost an entire dollar to close at the very, 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 very top end of the day's trading range. And that says to me, the dip buyers are out in full force, and they're seeing this sell-off as an opportunity, and a real opportunity it could be. Now, from a chart point of view, if you're familiar with my rules that I put out in my masterclass and that I follow, this right now is in breach of several of our classic rules. So you could say, well, why don't we wait till we break above the 50-day moving average line and maybe even the 150? So why don't we set a buy order that buys us at, say, $21 or slightly below here, because that way we know that there is really some oomph in it, and then we check on the volume, and that's probably a very, very good thing to do. And I haven't exactly decided yet where I will post that. I might also consider options. Again, that isn't for everybody, but at the moment you don't want to be buying options when IV% is at 73. Options are expensive. And let me show you a little illustration here. You see this options trade? Right. So if you set up, say you bought a call, like a leap option a year out at this level here, right? So what would happen is that, say we go into May or something. So, and we say we're trading still at roughly the same level, it's about $20, we make 165%, right? But if volatility came down because we were going up, now the same $20, we're only making 50%. So volatility, you see how that, this white little line here is your break even. The green bit's where you make money, the red bit's where you lose money. As volatility moves up and down, it has a huge impact on profits. So you really need to understand that before you do anything. And I just recommend people start with charts, start with stocks, get really good at it, get your risk management really dialed in, be really clear about the points where you buy. And then if you're loving that and you're doing it incredibly well and nice and consistent, then maybe have a think about options as well, because it is a very cool tool. But yeah, right now we need to see a little bit more of a move up. That candle there on Friday might well be the market bottom. It's a classic telltale sign, but I like to wait always an extra candle or two to see that this is actually happening. I think the opportunity is significant. Now, with anything, there is risk, of course. So how do we approach that? Make it a really small position. Of course, I'm not telling you to do this. I'm just telling you what I'm doing. So say you put 1% of your portfolio into a position like this, right? And it doubles or triples or something like that. Well, then that 1% gives you 100% gain, and now you have 2%. And you're like, yay, brilliant, fantastic, right? But if the 1% goes to, well, if it collapses and or blows up tomorrow, well, you have lost 1%. You don't really notice it, right? So for me, I kind of look for these outsized gains, and we can make that 2% potentially that gain a much greater one by using some leverage tools in there responsibly, of course. So always do things small, only do things you properly understand. But I just want to share some of these ideas with you that are a little bit like off the beaten path here, because I think it'll hopefully inspire you to learn so you too can spot these opportunities and you too can potentially make a lot more money from your money, which is really what this is all about. But of course, there are risks with everything. Shipping is a cyclical business. You don't really want to be holding shipping stocks for the long term because it's a mad world. Just look at the stock chart here, right? This was trading at $80, $90. So at 18 right now, we're kind of interested in it. We actually interestingly called a breakout. I didn't actually notice that. Down here at about $15. And then since then, we've basically followed the pattern that you will see in my masterclass pretty nicely. So we might actually want to draw a little line here and then say, well, wait for the breakout and go a little higher. So learn the rules. That's always more important than the golden nugget, because I can give you a fish, right? But the fish will go smelly, it'll go off. And then once you've eaten the fish, you're like, where is the next fish? So I'd much rather give you the fishing rod, give you the rules, give you the skills so you can be a better investor for yourself and your family and get to freedom and enjoy yourself, which is really what this is all about. If you enjoyed the video, share it with a friend or a golden retriever. There's one sleeping down here. Winston. There he is. There he is, attentive as always. And we wish you a beautiful day.
If you're worried what your favorite tech stocks are going to do this week, will they continue to rally or will they crash and burn again? This is the right video for you. I'm going to walk you through my week ahead watch list here. The S&P, NASDAQ, Tesla, Palantir, Volatility Index, SoFi, Microsoft,